In this video, I'm going to be cutting through the noise. I'm going to show you how to make money in real estate, what to look out for beyond just the surface, and skip all that sort of fluffy stuff of step one, get pre-approved, because we've heard that all before. So let's get into the real meat and potatoes of what it actually means to own real estate and how to make it work for you. Now, most people think that real estate is as simple as buying a house and paying it off month by month. And if you're listening to the headlines, you might believe that interest rates are through the roof and prices are crashing, and now just isn't really a good time to buy. But here's the truth. Real estate is so much more than the price tag or what the media is shouting about. We know that the real estate market is cyclical. It goes up and down and up and down historically, but the fascinating thing is that if you take a step back and look at the bigger picture, you'll notice a pattern. While there are short-term fluctuations, yes, the long-term trend has consistently been upward. I often get asked this question of, hey Alice, how can I position myself in this market to get ahead? Or, is that a good time to buy because of everything that's happening? In today's video, I'm going to answer those questions by breaking down the key real estate fundamentals of how real estate works. I just want to preface this with saying that my goal here is not to make you or convince you to buy or sell. My focus is on giving you the tools and insights so that you can make the best decision for yourself at the right time. Now, we're not here to debate whether you think that real estate is overvalued or undervalued. That's a conversation for another day. What I want to do is to focus on how you can use real estate as a powerful tool to build wealth and what to look out for far beyond how many bedrooms, the floor plans, the neighborhood. Whether you're buying a home to live in or invest for the future, the principles remain the same. Okay, so what are we going to talk about? We're going to talk about what equity is and why it is the key to building wealth, how mortgages actually work, not just how much you're paying on a monthly basis, and what an amortization schedule means, because understanding this one key factor is going to help you with timing the market to an extent. So one of the biggest advantages of owning real estate is building equity. Purchase a property, you're likely to obviously take out a mortgage. And each month, as you make your mortgage payment, a portion of that payment will go towards reducing your loan balance, and this is called your principal. Over time, your equity grows in two ways. Number one, as you pay down your principal, and number two, as your property increases in value. Other portion of your payment goes towards your interest, which is what you owe to your bank or your lender for borrowing that money. So your equity is essentially the difference between your home's current market value and the amount that you still owe on your mortgage. So for example, if your home is worth, let's say $800,000 today, and your mortgage balance is, let's say $500,000, your equity is $3,000. That would be approximately how much money that you would have if you were to sell your home, give or take, because there's obviously closing costs that are associated with the sale. Here's something interesting that I don't think most people know. Real estate appreciates in value due to several key factors that drive obviously demand, limit supply, or improve the desirability of your property. Now, while the market obviously has its ups and downs, long-term trends often show steady appreciation. So real estate cycles are influenced by, we know, economic factors. We know that they're influenced by government policy and market demand and supply, but over decades, I could show you the numbers, property values do tend to rise. Now, what I find fascinating is that over the last 40 years, real estate here in the GTA has appreciated on average at an annual rate of 6.79%. Now, this figure accounts for both the highs and the lows because, let's face it, not every year is a stellar one, and we've certainly seen some recent challenges. But here's the thing. Down markets often create significant opportunities, especially if you understand concepts like amortization and how they fit into the bigger picture. But this is why timing the market is so difficult and why your time in the market matters far more. The longer that you hold onto a property, the better your chances are of riding out any sort of short-term fluctuations and benefiting from long-term appreciation. But okay, so we know how home equity is built. We know how home values appreciate long-term. But what about answering this million-dollar question of, is it a good time to buy? So in addition to equity and mortgages, something that many people don't really talk about is amortization and the amortization schedule. And in my opinion, it is probably the most important thing to consider if you're considering if now or later would be a good time to buy a property. This is really sexy stuff, I know, guys. Hey, I never said this was selling sunset. I'm here to show you how to make money in real estate and how to make sense of it, okay? I often hear people say it's a horrible time to buy right now, which is followed by concerns of obviously higher rates. And those are valid concerns, no doubt. So for those that do want to buy and who are sitting on the sidelines, they probably have a dilemma, right? Should you buy now at a higher rate or wait for rates to drop knowing that home prices could potentially increase? So if you're concerned about saving money, listen up. So one, as I mentioned, often overlooked factor is this amortization schedule. Now, understanding this can completely change your view on whether to buy now or to wait. So what is amortization? So amortization is the process of gradually paying off your mortgage over time through regular payments. And in Ontario, most mortgages are amortized over 25 years, although shorter or longer terms are also possible. Now, your monthly mortgage payment is split up into two parts. Principal, the amount that reduces your loan balance, and secondly, interest is what you pay to the lender for borrowing your money, as I mentioned before. Now, in the early stages of your mortgage, most of your payments go towards interest, while only a small portion of that goes towards your principal. So as the time goes on, the balance does tend to shift, okay? And more of your payment goes towards reducing that loan balance. This is another reason why it is important to have a long-term view of real estate. So I'm going to show you two scenarios here because we know that when rates go down, more people jump back into the market because those monthly payments start to look a little bit more feasible. They start to make a little bit more sense to people, which increases demand. And we know when demand increases, so do home values. And that's just the reality of the market, right? And we've seen this play out historically in the data. The question is how much home prices are going to increase. Well, that really depends on everything else that's going on in our economy, job security being obviously a major component and factor of this. So in the first scenario, we're going to pretend that the house that you want to buy is $800,000. You're going to put down 20% at an amortization of 25 years at the current variable rate of 5.45%. Now your monthly payment would be $3,888. Great. But let's jump into the future a little bit and, let's say that rates have dropped another 50 basis points, bringing that 5.45 to 4.95, but that $800,000 is now $60,000 more. And I'm using this number because since August, we've seen a 50 basis point cut to the rates and the average price of a home has increased $60,000. So instead of $800,000, the house that you want to purchase now is $860,000. So you're still going to put down 20%, amortized at 25 years at a new variable rate of 4.95%. Your monthly payment is now slightly higher at $3,982. Now keep in mind that your down payment and your land transfer tax is also going to be higher because it's calculating at that higher purchase price. So not a massive difference on a monthly cost, but let's fast forward to now that you want to sell that house because you've been living in it for 5 years and now that you need some more space or you're moving for your job or you have to sell or whatever it is. So in scenario one, with a lower purchase price and a higher rate, you would owe the bank $570,000 on your mortgage. And in scenario two, you owe more. You actually have an outstanding mortgage balance of $608,000. And you're like, Alice, well, why? I had a lower rate. Well, you purchased at a higher price and any savings that you thought you've had waiting for rates to drop, prices rose and now you're paying interest on a higher ticket price. Additionally to this, in scenario one, you're paying $161,000 over the 5-year term of interest. That's to the bank. And in scenario two, you're paying only $104,000 of interest. So is it better to wait for a lower rate? As the saying goes, the money is made on the buy in real estate. And the key takeaway to this is to focus on building equity. Keep in mind when you're discussing this with your realtor or your mortgage broker, it's essential to run different scenarios and to see exactly what it is that works best for you. Whether you are just looking or you're starting out in your journey, it's never too early to connect with a realtor or a mortgage broker. The good ones will be patient with you and to take their time and to show you what's up, not just tell you, and to run you through the different scenarios and what they actually mean to you and your goals. There has been many times that I have worked with clients who sometimes have taken 2-3 years to make a purchase. And you know what? That's okay. That's what I'm here for. I'm here to serve, to answer questions, to share knowledge, to guide you, and to provide relevant information to you so that when you're ready, you're actually ready. Now, if you would like to connect, you can use the Calendly link below to book a time that is convenient for you. And until then, I will catch you on the next one. Ciao.